Up, guys? Hope you're doing well. Hey, I want you to consider something right now, which is how do you process the word average? Average. And in other areas of your life, do you process it differently than in some other areas of your life? So let me use an example grades. If I were to tell you, hey, at your high school or at your college, hey, the average GPA is a 3.0, what happens in your mind? Do you think, cool, that's irrelevant because I'm my own person? Do you think, ooh, all right, let me try to get a 3.25? Do you think, hey, I don't know if I'm going to be able to get that? Maybe 2.5 would be good for me. If that's the average, I'll probably be lower. Do you think you'll be way higher? Do you think, all right, that means I'll get a 3.0 and there's absolutely zero opportunity for me to do anything else other than a 3.0? Now, the last option I gave you is probably not how you process the word average. Similarly, as it relates to real estate, for example, if I were to tell you here's the average rate of return on real estate across the country, and you were interested in being a real estate investor, you might not be so compelled by that figure as if it was incredibly restrictive, because you know that every property is different, the location, the proximity to the things around it, the beauty, the nature with it, the natural resources maybe in the ground. And you got, what city is it in? Is it even in a city or is it rural? Like, these are very different markets. You can't just take one average, throw everything into the pot and say, well, that's going to be your return. That's all it is. And treat, something in downtown New York City the same way that you would in Omaha, Nebraska. Very different markets, right? And within those markets, all sorts of different unique properties. But here's what's crazy, guys. This is how almost everyone processes investing in the market, in the stock market, in publicly traded businesses. They say, well, on average, active investors, they lose money compared to just throwing it in the S&P 500. Well, on average, the S&P 500 net of inflation, maybe it makes 8% or so a year. So that's all I can do. 8%. Anything more than 8%, it's a pipe dream. It's a Ponzi scheme. It's a get rich quick trap. And hey, anything lower than that, that's probably fine too. But it's probably just going to be the average, because that's the average and there's no such thing as beating the average. Guys, that is crazy. That is crazy, particularly when you think about how even 1% difference extrapolated over decades, compounding over years upon years upon years. If you can make 9% instead of 8%, there's millions of dollars on the line related to that. At least hundreds of thousands, depending on how much you're contributing each year, of course. But for so many people, there's this mental block of, oh, it's impossible. And the point of this video is, no, it's not. It is not impossible. You don't even have to be a genius. You don't have to know how to read charts. You don't have to use all these stocky words, you also probably shouldn't just, hey, I can just listen to these YouTubers and just do whatever they say and then I'll make a killing. No, you should make your own decisions. But what I'm saying is your decision making doesn't have to be so ultra profound. There's probably at least one sector within the market that you have an intuitive thumb on more than a lot of people. There are a lot of businesses that target teens, that target 20-somethings. Do you think you might know more about that business than an 85-year-old that's managing some pension fund somewhere? You probably do. Did you have to be like a fortune teller? I was going to say, do you have to be a psychotic? But what I was going to mean is a psychic to know that, oh, wow, I think people like shopping on Amazon. No, You didn't have to know that in 1999. You could have known that in 2009. That would have still been a great outperforming asset over that 10-year time horizon. You don't have to just be so crazy smart. Outperforming the market is as simple as taking 1,000 companies, just every company in the world, and say, which there are more than 1,000, okay, but take however many companies you want, and how could you ever decide if one was more attractive than another? Here's the thing. Your reasons don't even have to be strictly financial. It doesn't have to be a discounted cash flow of the projected earnings over the coming 5, 10, or 20-year time horizon. It could just be, what do you believe in? Vote with your dollars, right? Invest with a purpose for a cause. For example, in 2019, I started investing in Tesla. I did, of course, have a brainy aspect to it, but I also just thought, if we have 25 automakers that are all bent on keeping the world on gasoline and diesel, and we have one that's bent on creating a sustainable energy future for our world, I really don't want that one to go bankrupt. Like, if the technology is there to support this transformation in transportation, I think that would be better for the earth. And so, therefore, I'm going to invest some dollars there. Those dollars went up like 15x. Was I a genius? No, I was not a genius, okay? And you don't have to be a genius either. But it all comes down to, how do you process average? Is it a limitation? Is it a challenge? Is it something you won't measure up to? Is it something you'll do a little better than? Or is it something that I said, or is it something? I'm from Texas, guys. Or is it something that almost feels irrelevant, because you know that nothing you're doing is just based on a law of averages, but you look at every investment as a specific opportunity with its own trajectory that's not specifically limited by what any other company might be doing? Hey, if that is you, let's talk, because we could invest some dollars together. That's not the point of this video, though. Just want you to be thinking about how you process averages. And hey, the stock market doesn't have to be an exception. I'll talk to y'all soon.